Assalamu alaikum friends, welcome to SBR revision series for September 2021, IS 28 separate financial statement. This topic is also equally important for your group accounting. Okay, it will be asked in your group accounting for your question number 1, which is for 30 marks. Because not every time you will be asked on consolidation. Remember, there are questions, okay, you can go through your revision kit and see they have asked the impact, what would be the impact on the consolidated financial statements, and also what is the impact on the separate financial statement. Remember, not everyone consolidates. Sometimes they don't consolidate, but they prepare their separate financial statements. So how will they record it under their separate financial statement is different to the how they will record under consolidated financial statement. That's why this standard is also very important for your group accounting. Okay, it does not come very frequently, but it has come. Okay, so this applies to entity who has an interest in subsidiaries, joint ventures, or associates. It could be anything. It could be interest in subsidiary or joint venture or associate. Okay, and they prepare separate non-consolidated financial statement. That means every subsidiaries are preparing their own separate financial statements. Every joint ventures are preparing their own separate financial statements. Every associates are preparing their own separate financial statements. So the way they record it will be different to the consolidated financial statement. That's why it's important to know how the impact will be different between these two, consolidated versus separate financial statement. Now, how do you account under separate financial statement? Okay, whether it's investment in subsidiaries or joint venture or associate, it could be accounted in the following three ways. Either you can record it at cost. Okay, for example, if you have bought a subsidiary, you record it at cost. But in your consolidated financial statements, how do you write it? Fair value. We take at fair value. We consolidate everything line by line, but at fair value. We find the goodwill, we find NCI, right? Next, in accordance with IFRS 9 financial instruments. If it's for financial instruments, okay, we are using the rule of IFRS 9 because investment in another entity comes under IFRS 9 only. Or using the equity method. So for joint venture or associate, it could be equity method. But if you're having an interest in another entity, which is less than 20%, then you have to use IFRS 9 financial instruments rules only. Okay, so for separate financial statements, remember these three. Cost for subsidiary and less than 20% investment in an entity, IFRS 9, and associates and joint ventures, equity method. Okay, so that's it for separate financial statements. And there are questions they have questions in your revision kit. Please solve them. And till then, we'll see you in the next standard, IS 28. This is also important for your group accounting, which is your investment in associates and joint venture. There will be going in depth how the equity method looks like. Till then, thanks for watching.